Hello, everybody. Welcome, James and Ira and Rob and Robbie. Hope everyone's doing okay today.
We
I think we
are.
make this.
Welcome yourself, Mr. Kessel.
I think, let's see, three of us on the East Coast and Rob's in Northern California. Did I get that right?
Yes, indeed.
Okay.
Yes,
Well,
indeed.
I'm gonna fill in here a first time
Hang on,
moderator.
hang
So
on, hang on, hang on. Rob, I have to interrupt right from the get-go. I understand why Ira and James are on the East Coast. Why are you, who's more of what part of the East Coast are you in and why?
I'm in Washington, D.C. I did a little boat tour over the weekend, and I'm visiting my son who goes to school here.
Very good. So it's not like you're part of the like Missouri National Guard or something?
No, siree.
No. All right.
Although I've seen plenty of National Guard around, so
Uh,
there's still a presence here in the city. But let's kick things off. And so I think this is what I'm going to do really terrible. So this is the this series is sponsored by Poly, right? The pricing engine and AI, and thank them for uh, promoting and sponsoring this session. So we'll get that mentioned, and then I guess we had some topics that I think we distributed out that we're going to talk about today, and I think one of them is pragmatically what a government shutdown might do for our lending business. And so let's kick that off, and maybe I'll start with Ira on that as far as what's maybe happening in the now, or what do you worry about possibly happening if it extends out a couple more weeks?
Sure. Thanks everyone for joining. The one thing the government shut down, it's definitely a fluid situation. So when it first came out, we anticipated certain hurdles, and as the beginning days of the shutdown started, we found additional hurdles. I think the two of the biggest issues we're seeing, number one is loans in flood zones. So we're running flood certs on obviously every file. Loans that happen to land in a flood zone, there's no way to get a official policy. So there's a few different options. We could provide, approved applications, um, and then, assuming there's no claims in between now and the time the government officially the shutdown ends, hopefully there's no claims in between then. So that's our first problem. Second problem is government workers. The status of all these government workers is a little bit unknown. Hear lots of stories of some that are working but not getting paid, some that are have been temporarily laid off, some permanently laid off. So obviously there's going to be problems in getting employment and or pay verifications. There's still questions as to whether they're going to earn their back pay. So that's another hurdle that we're running into. FHA loans, we're still processing as normal, conventional loans still processing as normal. And then the other piece that we don't see a lot of business in from our company is USDA loans, rural housing. And that's more or less shut down from what I've seen. Um, you know, not able to get financing for those loans. And obviously, depending on your business and the type of business you do, it could have varying degrees of impact to the bottom line. But it's not fun. It's not pretty, and unfortunately, it doesn't seem like there's any hope. We'd like to see at least talk of some progress, and it just seems like it's ongoing, and I don't see anything happening.
Hmm. James, how about yourself? It's always hard to, each of you guys bring so much to the table. It's hard to follow you, but after Ira's breakdown, what are your thoughts on it? And just maybe even touching on like what lock changes you might be anticipating, or different things that you might have to do to support the borrower and the production
Yeah.
staff. Maybe touch on that.
Yeah, I think, to Ira's point, a lot of it is, well, I guess actually to even take one step back, I think the thing that most strikes me about this particular iteration of a shutdown is that the market's been very calm, like just starting at a very high level, right? Like the usual cadence of tradable events has been disrupted. We're not seeing, for example, the non-farm payroll report or the updated unemployment rate. Looks like we are going to see inflation data in a couple weeks, but again, it's just kind of the market is off its typical cadence. But I think at the same time, the market's been taking this in relative stride. The yield on the 10-year is down about 10 basis points since we started, and the S&P is basically flat, maybe a little higher after today, right? So it's hard to say that there's been a ton of impact, which I think in and of itself is pretty striking. Because to Ira's point, there's a great deal of uncertainty out there. In terms of how it's affecting the business, a lot of our conversations have been educating the borrower and explaining kind of the intricacies that I was talking about in terms of government workers in particular, in terms of how to handle a borrower who has been furloughed. Are you still able to close a loan? And so on. I would say for the lenders out there, certainly Fannie and Freddie have done a really good job of publishing guidance on what they basically what the playbook is. But at the same time, it's very worth picking up the phone and calling your account reps and just making sure that you're crystal clear on everything. I would say one thing in the spirit of positivity, which is that there's at least a little bit of a market opportunity for prospective home buyers. And that certainly has been a conversation we've been having internally that, as the stock of potential home buyers kind of slows down a little bit, and there are some that are candidly on the sidelines, non-government workers or those that, are less affected are going to have more of an opportunity to put together a better offer, maybe be a little less rushed, right? A little less competition and so on too. So that is a bit of a message that we've been taking to some of our originators, is just make sure that we see, hopefully the opportunity in this as well.
I love it. Glass half full.
I try.
And continuing with that boyish optimism, Rob Chrisman, you want to add some of your own?
Well, sure. The shutdown, in effect, whether it's man-made or natural, slows the economy, right? And you can make the argument that it slows the economy on a temporary basis, because at some point the folks will come back to work. At some point, the departments will open back up at some point. But for now, it's having a dampening effect on the economy. If you're furloughed, you're not going out and buying a house. You're not getting a new credit card. And so you would think rates would drop more than they have. They've dropped a little bit. And most of that came, I think, on Friday when President Donald J. Trump was talking about China and tariffs, which he then recanted over the weekend. But that aside, I think that traders and investors have been so buffeted from one side to the other, up and down, on and all around over the last 9 months, that this is almost a non-event. It's calming almost in its non-volatility. And it is interesting. I received a few emails from people saying, why is Donald Trump going off to Israel when we are in the middle of a government shutdown? And I think President Trump has indicated that it's up to Congress to figure this out. And there's another school of thought that says the government is run from the top down, and so who's ultimately responsible is the President of the United States. So you've got these schools of thought, and of course they're arguing about healthcare costs and other things that really people are saying, well, they'll figure it out at some point. At some point there'll be a breakthrough. But until then, it's the sun comes up in the morning and stocks keep trading, bonds keep trading, and for the most part, the world functions. I just wouldn't want to have scheduled a national parks tour in October of this year. You'd be out of luck. But Yeah, from an optimistic standpoint, yeah, rates you would think would come down more because of the economy slowing down. So that's happened a little bit, but not maybe as much as it could. So maybe we'll see further rate declines coming up the longer we stay in a shutdown.
You know, to take that vein and continue it, one of the, and of course, I'll be pedantic and say, of course, in capital markets, we don't think about where rates are going. We're always prepared if they're going either way. But that said, one of the interesting things I've been following is this Supreme Court case on tariffs. And if they decide and rule that the president can't impose the level of or the extent to which he has the tariffs, what that kind of does to the inflation fear or the inflation story that's maybe been one of the holdups and rates coming down further. Um, Anyone want to grab that? James, you want to grab that topic and comment on that?
I think it's fascinating. I couldn't agree more. And I think, you've started to see in the recent weeks a little bit of a hedge from the administration where they're saying, hey, if it's not on the table under strategy number one or legal basis number one, we can perhaps consider legal basis number two, and so on. I think to your point, Rob, that the challenge that is inherent when you have such broad sweeping change, good, bad, otherwise, whatever, the audience or anyone thinks of it, right, is that we are kind of playing in uncharted territory. And candidly, I think that's what's made the Federal Reserve's job so difficult in this particular last year, I should say, because they haven't seen the level of inflation that we've seen, coming out of a pandemic. And you could explain away a once in a century pandemic, and you could explain away that, yes, I'm sorry, I don't have a great playbook for how to deal with unprecedented tariffs, and so on. It's a very challenging job, and certainly they've made some mistakes and so on. But at the same time, you look at the hand they've been dealt, it makes it very difficult. But yeah, agreed. The fact that all of this is the president's signature economic policy is very tied up in a court case that so far hasn't gone favorably, I think is a very interesting overhang for sure.
Mm-hmm. Ari, you got anything to add to
Has it?
that?
Well, what makes you say, James, that it hasn't gone? Oh, I'm sorry. Go ahead.
Oh, no,
Oh,
I was just going to add,
Oh, well,
I'm sorry, I
I
was
just
just
wanted
going
to
to add
ask.
one quick thing.
Yeah, go ahead, Ira.
So I was going to say the one interesting piece that I find in all this is as this continues, we have this backlog of data, and it's going to be interesting to see, number one, when this data gets released, when the shutdown does get resolved, and what the ultimate impact on those data points are. How are we going to have 2 months of payroll data that's going to be delayed? Are we going to have all these other data points that are going to be delayed, and when are they actually going to be released? So in terms of, we mentioned the Fed and their actions, what data do they have to go by right now? So that's where my focus is a little bit on, is, when we do get these reports and what they're going to show.
Mm. Rob, you had a
It's
question for James?
interesting. Well, I wanted to ask James, when you say the tariff question hasn't gone well so far, there's some a fly in the ointment. Couldn't the argument be made that the Supreme Court has overwhelmingly ruled in favor of many of the Trump administration moves, and therefore the tariffs are expected to fall into that category of another favorable ruling? I mean, is there anything that would lead you to believe that they may not approve the tariff policy?
Yeah, I mean, I think, we'll see, right? We're living in interesting times for sure. I was referring to the two appeals courts so far that have ruled against it. But, to your point, and legal scholar that I am, one of the things that I think is interesting is certainly the court in recent years has discussed this idea of a major questions doctrine, and so on. And basically the idea that they're skeptical of when the executive branch or whenever it happens to be finds very powerful powers that were not clearly enumerated and so on. So on one hand, to your point, Rob, agreed, certainly a lot of rulings have gone in their favor. On the other hand, it sure seems like this one might be afoul of that. So it's going to be a very interesting court case to review because you know, on one hand the trend, on the other hand maybe not. So we'll see. But anyway, that's what I was referring to.
Mm-hmm. And read
Yeah,
similar
it's
things myself.
interesting. I had. Oh, go ahead, Rob.
Yep, all yours, Rob.
Oh, the it does, and I know this is a mortgage show and it's about capital markets and so on, but the obviously the psychology of the investors impact they're wanting to pay up for, in this case, treasuries or mortgage-backed securities, and there is an undercurrent out there that says even if the Supreme Court does not approve the tariff policy, what difference does it make? Who is going to stop the government, from doing something? Or put another way, when the Supreme Court rules on something, who enforces that ruling? It's not like the Supreme Court has any kind, it doesn't, the Supreme Court doesn't really have a stick to beat people up with. Um, so they may rule that the tariffs are unconstitutional, and you may have the administration shrug and say, well, yeah, oh well. Um, Regarding Ira's question about the amount of economic news that we could get swamped with, I know that the part of the Bureau of Labor Statistics coming back in to come out with a consumer price index report. So we'll have one data point. But Ira, correct me if I'm wrong, or maybe somebody else can correct me if I'm wrong. When you look at the Federal Reserve and they have the 12 districts that are out there, and each one of these folks is a president of their district, they look at data within their district. And so they may be able to piece together information that they use or will use that may actually be more valuable than some kind of federal release if they are able to tap into their sources within their districts. So maybe there's some of that going on out there. I'm just throwing that out there as a thought.
Let's from the audience, we had a question about how does 10-year rates relate to mortgage rates? And so I think we've covered that a little bit before. It's always good to revisit. The expectation is when we hear the 10 years going down, people are thinking mortgage rates are going down. Um, we've talked, I think, before in some of our earlier podcasts about how there's a spread between mortgage rates and treasury rates and what some of the components of that spread are. But maybe starting with you, Ira, what do you, as far as you looking at that, or how you might explain that to production, what's the internal conversation about that spread?
Yeah, I know. I think, personally, I think a lot of people, are still used to, 4 or 5 years ago, we had those low spreads, right? Rates are in the threes. We had that 10-year super low, and obviously, we had a portion of quantitative easing and a whole bunch of different factors that naturally caused that spread to be a little lower. When people talk about, that the current spread is not normal, I think that's where I sort of find trouble with comments on the current spread not being a normal spread. I think the spread is going to change based on various factors. The Fed is not purchasing MBS. The Fed is not purchasing. So there's a lot of different factors that go into that spread. And, you sort of can't look at the past so much to expect that spread to be naturally down to 1.5 or 1 3/4. We're in a different environment. And, rates, it will naturally come down as rates come down. But I don't expect, just the spread to automatically come down for whatever reason. And I think a lot of people sort of always look to that spread, sometimes too much. They expect that 1.5 and 1.75 spread, and they go, okay, we're sitting here at 4.01. How come rates aren't at 5 3/4? And I think we will see that spread decrease as rates decrease, hopefully soon. But otherwise, there's nothing really that's going to push that spread further down otherwise.
I mean, the life of an investor, like the industry is so gravitated towards a certain amount of margin that you're up in the 102 and a half, 103 range, to kind of get a par quote for the borrower. And with all the specifieds out there and just, how much premium you need, there's that good old negative convexity where the prepayment assumptions are so pronounced when those rates keep going up that it's a dicey investment for investors. And so it's increasingly need more rate, right, to get the same premium expectation. And I think that's compressed some of that. And it's also, it's part of the widening spread. Rob, what would you add to the whole mortgage treasury spread scenarios?
Well, I think it's important for folks on this call to be able to explain to others, why there's a spread. And the basic answer is, well, there's credit risk and there is prepayment risk, or a loan paying off early. And if you're an investor and you're paying 103 or 104 or even 105 for a loan or a pool of loans, and the loans pay off 3 months or 6 months later, and you get back par, you just lost 3 or 4 or 5 points on your investment. It's not a good situation. But I think people have to remember that whether it's federal workers or whether it's the layoffs, Doge, the implications they're on, whoever is getting laid off, what I'm hearing is that credit risk has crept back into the national conversation. Gee, we are in a shutdown. Employees are may not feel comfortable with their employee status. You have credit card debt has been increasing. You've got student debt, you've got car debt, and there's all kinds of different ways to slice and dice debt numbers that are out there. But gee, FHA delinquencies are creeping up. What's going on with VA? What's going on with, some of these components of the mortgage population that's out there, of the trillions of dollars. And so you have a situation, like I said, that's been creeping into my inbox somewhat, like, gee, is this impacting the potential credit quality of existing loans or existing pools of loans? If you're furloughed, where are you going to make your payments? What are you going to do about that? Is there credit risk that's starting to ramp up a little bit because of an extended shutdown? With regard to prepayments, rates have been creeping down, and so investors have been less likely to pay a premium for loans. If rates do continue to come down because the economy is slowing and unemployment is going up, then that'll mean that the prepayment risk is actually increasing on recently issued mortgage-backed securities, 6.75%, 7%, whatever interest rate. And so that will also cause investors to say, do I really want to own mortgage-backed securities if rates keep coming down and or if there's credit risk that's increasing? And so, to play devil's advocate a little bit, I don't know if I foresee that spread narrowing, frankly. Um, it's just things for us as an industry to think about going forward.
I think
Really good.
that I think as you talk about going forward, one of Rob Kessel, you brought up the idea of loan sizes and so on, and certainly it's a topical time right now as we look at a new potentially conforming loan limit coming up. But I think, to the point that you're making, Rob Chrisman, one of the things that we've seen in recent rallies is even though the relative rate is going down, kind of the survey rate, the headline rate that we're seeing, we're really not seeing the return of premium pricing to the market. Intuitively, we think, oh, okay, good. Rates are now not 7, they're 6. That must mean that if I'm at 6.75, I can actually give a lender credit, for example. But the reality of it is, and there's a whole host of reasons, including some of the ones we've articulated, but with the conforming loan limit continuing to increase, I mean, it wasn't so long ago, right? The conforming loan limits were 417,000. That was 2016, right? And today, GSE cash windows are offering specified payups for $325,000 loan stips and 350 loan stips. And the largest securitizers are creating 375 and 400K. And so again, less than 10 years ago, that was the conforming loan limit, right? So the kind of practical takeaway from that I think we're all kind of coalescing around is, again, communicating to loan officers. If the question becomes, hey, where's my premium pricing? How is it possible to give a lender credit? It's very difficult because the increasing size of these loans, among other factors, right, increases the inherent refinance incentive in these new production loans. And when you're a TBA investor, when you're an MBS investor, and you might have a pool of $800,000 conforming loans, that's just a very different prepayment profile than a conforming loan balance would have been, a couple years ago, right? And to your point, Rob, as well, that makes it really difficult to pay a 105, for example, dollar price on just new production generic mortgage-backed securities and so on. So I think, again, it's the answer to the question of, hey, where did my premium pricing go, and where's those lender credits, right? As well as, of course, from a technological point of view, it really means that lenders need to be especially sharp in terms of their loan size and profit margin kind of structures as well.
Right. If you think about the prevalence of specified payups, like, sometimes you hear 60% of bonds are spec payup, are story bonds that are being originated. And you think about most of those are slower paying stories. And then you think, well, what's left? You think that, hey, if all the slower paying stories are left, then aren't the longer paying stories the ones that are going to TBAs? And give us a break, maybe have that spread come down a little bit. But anybody want to add to that topic before we move on to the next one?
I'll just add one thing, which is what you're talking about is exactly what we see in the government TBA market, where effectively, government pooling practices, not to go too far into the details, but generally speaking, VA loans that are much easier to refinance are getting delivered predominantly into multi-issuer pools, or rather, I should say, the percent of VA loans in multi-issuer pools is certainly higher than it used to be. And lenders carve out 100% FHA stories, 100% USDA stories, and so on, because again, the granularity of the different prepayment speed profiles is just very different. So that's exactly what we see in the government side of the house. And again, that's a difference from just, say the last 5 to 10 years, et cetera, that generally speaking these days, the multi-issuer pool is mostly VA loans, and the slower prepaying stuff is getting put into customs.
Ira or Rob, anything you want to add?
Just I found it interesting. Well, I mean, not surprising, but a little interesting that, in previous years, the advanced early loan limits that various lenders have rolled out has been questionable, maybe a pretty high increase from the previous year. And it seems like this year, it seems like most people that have released early conforming limits it's been an increase of maybe a little less than 2%, which seems a little more normal than previous years. I know the agencies in the past have said they don't like lenders releasing early loan limits before they're officially announced, and it'll be, I think, November 24th or 25th, I think is the date. But I did find it interesting that the amount of the increase was a lot smaller this year, expectedly.
All right. Well, that's one of the, and I know that was one of our topics too. I don't know if Rob or James, you want to add anything on just this particular increase or what lenders are doing ahead of it. James, you have anything you want to add on that?
Yeah, I would just say, in terms of this particular increase, to Ira's point, we expect the formal number to be published in right around Thanksgiving. And it's based off of FHFA's home price appreciation surveys. And so we have the last 3 quarters. We don't have the next one yet, right? So we'll get the formal number to it. And so HPA has certainly slowed down this year. And so while we are seeing an increase, it's not like it was a couple years back when we were like 17% or something outrageous. Again, it's an important conversation for a lender. theoretically, there's always the risk that FHFA will deviate. We do have a new FHFA commissioner these days, right? And so it's plausible. I don't think I'm going to bet on it, but it certainly is plausible that they would not follow the same playbook as in the past, although I find that a little bit hard to believe that they wouldn't give some kind of guidance for it, but one never knows. So I think that it's an important thing for lenders to consider how to roll out that, if they choose to roll out the new conforming loan limits, if they do, how much risk they choose to take in doing so. Generally speaking, warehouse banks will not allow lenders well, they won't wet fund a loan that doesn't have a commitment, a takeout. And if you have a loan that you're closing above the conforming loan limit, right, it's an unsaleable loan, technically speaking, at least until the limits are released. So it's a good conversation for lenders to have. You know, do they want to offer the new conforming loan limits and give the originators a win? If so, how aggressive do they want to be? Certainly a very good conservative strategy is to commit the loan on a best efforts basis to an investor who's jumped the gun a little bit, right? But it's a good risk reward conversation for capital markets team to be having with their leadership as well.
Hey, I've got a question for James or Ira. the I've seen, I don't, we haven't really talked too much about this, but it seems to me that we as an industry have seen Fannie Mae and Freddie Mac, and I've used this analogy before, but going 10 miles an hour in the fast lane, their market share, I think, has been declining somewhat. When you talk to loan officers, you know, the increase in private money lending has really jumped up. Non-QM, non-agency lending has really jumped up. Are the agencies as relevant as they once were? And B, and I'm sure expressing my naivety here, do non-agency investors, i.e. non-QM investors, do they even have are their loan limits more like in the $1 million range where it just Fannie Mae goes up and down a little bit? They don't even care. So does it matter anymore, or does it matter as much as it once did?
Yeah, good question. I'll start. So to answer the first half of that, you know, notwithstanding, yeah, the market share does ebb and flow and so on, but you know, at the core of everything is still DULP, right? It's still we've seen in this year, for example, quite a few lenders introduce AUS jumbo products, for example, that nonetheless leverage the AUS findings and so on. Still the most reliably quick way to get a loan purchased and originated and transparent and so on. So yes, I would say as a starting point, you know, I think what they've done perhaps with the variant LLPA structures and some of the policies is they've introduced more of an opportunity for non-agency investors to compete in terms of some of the less mission critical loans in their mind. So things like investment properties, second homes, cash out refinances, things that are mission adjacent. They've given opportunity for other folks to come in and compete, be it a cash flow based or be it a portfolio lender. And yeah, I mean, certainly non-QM, it really does run the gamut in terms of what the investor programs look like. Some of them have very wide ranges of UPB. And some of them are very narrow, that they are very specialized and tailored on certain types of products, you know, DSCR, for example, or bank statement, but they still don't necessarily want more than say a $2 million loan, or even smaller for that matter, or at least they negatively incentivize it. So I think it's all over the place. But I think in general, again, to kind of answer your question, yes, still relevant, still the basis of everything, still probably the most efficient game in town. But as G fees and LLPAs continue to rise, more opportunity for competition. Ira, I don't know if you'd add or subtract anything from that.
Yeah, it's spot on. I mean, the nice part of it is it gives us additional, you know, executions when we're selling the loans off. We have more non-QM lenders, you know, buying or bidding on conventional conforming loans. You know, with those LLPAs, as James mentioned, you know, some of it by design, right? Fannie and Freddie, only a few years ago, they had put those percentage limits on the amount of second homes that they're going to buy, as an example. So, maybe some of it's by design. We've seen quite a few, traditional investors now lowering their minimum loan amounts on their jumbo products. So we had a couple that lowered their minimum loan amounts to $10,000. Previously, they would want that minimum loan amount to be at the conforming level. So definitely think that's going to continue. For us, it's nice to have those additional outlets. But as James mentioned, at the core, we're still seeing, those consistent guidelines and consistent LTVs and FICO requirements.
I mean, how about borrower experience? Like, are some of the non-QM products, are they close faster, easier, better experience, maybe worth an eighth or so in rate, or what are how is that being twisted a little bit?
I think on the where we're seeing that the most would be that DSCR product. I think from a loan officer and borrower perspective, instead of going through tax returns and, especially experienced investor and trying to go through their income and calculating their income and going through all the tax returns. Instead, if you could just approve and close their loan based on the cash flow of the subject property, borrower is going to take that all day versus providing, hundreds and hundreds of pages of documents just to get that loan closed quickly, especially in this environment, if they need cash to buy another property or things like that. So I think that's where we're seeing that the most in the terms of the borrower experience is in that DSCR product.
Yeah, I agree. I would just say as well, I think it really comes down to the type of lender and the lender's core competency. Some lenders, for example, well, I mean, if you think about the types of loans that a lender will do, the vast majority most likely is still going to be conforming, right? Conforming conventional, for example. And so that's the one that the underwriting team knows backwards and forwards, right? That's the one where if there's an exception, everyone's speaking from the same playbook. Some lenders are extremely skilled and extremely versed in all things non-QM. And others are still kind of getting their feet wet, right? So I think to your point, Rob, I think that when we're talking about, it's a really right question to ask, because as much as these are all different options, any loan officer will tell you that they want to set expectations, and they want their credibility to be able to look the borrower in the eye and say, hey, we're going to close you on time. That's point number one, right? And so on one hand, again, lenders are always looking for the best and brightest and the newest products that are out there, right? But at the same time, it's, can you execute on that? Can you deliver it? Can you deliver your credibility both to your borrower as well as internally too?
Yeah, that's a great point, James. If you're sitting there, and I'm not a loan officer, but to be able to sit there across from a bar and say, we're going to close you on time, that may mean way more for a given borrower than, oh, I got that, I improved your rate by an eighth, and I'm going to save you, $18 a month or whatever it is. Because, the moving van is coming over the weekend and they really want that loan to close. So good point.
100%, 100%. And it's funny, this being a capital markets podcast, sometimes we sit in our ivory towers and lose sight of that. And so I think it's so relevant that, yeah, most important is I will get the loan closed on time, right? That's critical. And that might be, absolutely, that might be the case with any DSCR lender, any non-QM lender, categorically, and so on. It's just, I think, again, it's how the lender's experience is and what their own institutional knowledge is that they can back up that claim.
One of the questions from the audience, if there's been any chatter about FHFA opening up other high cost regions or areas for higher loan limits.
I haven't heard that one myself. It's a great question. I haven't heard any rumor of that, but I don't know if any of my colleagues on the panel have.
Not that I've heard. I know, Florida, people doing business in Florida would love that, because there's only Key West is the only high balance available, but I haven't heard any. I know there's some calculations that go into it. And I think we would have seen an increase in those areas maybe a year or two ago with the increase of values, but I haven't heard anything as well.
We had one more topic on the docket today, and that was to talk about maybe a little optimistically about if rates keep going down, what does that make us in capital markets think about some of the non-solicit agreements we may have signed with some of the released investors that we signed up with, and just for context, different aggregators have different recapture staff and capabilities and terms in their investor agreements, the whole loan agreements that lenders sign with them. And so, now we're call it a year into a little lower rate environment, and just, how is it feeling? Maybe starting with Ira and then James, how does it feel with some of those non-solicit, or maybe you didn't go with any non-solicit, but maybe just kind of an update on thoughts on those agreements.
Yeah, it's something we definitely check when we're obviously signing up anyone new. There's various degrees of non-solicits, whether the borrower is proactively reaching out to you or you're reaching out to the borrower. It definitely is a concern, right? Especially now with the servicers being hyper-focused on retention. Obviously, they paid a lot of money at these levels, as we just discussed earlier. If those loans are going to pay off early, they want that loan back. And I think there are easy ways to see who refinanced that loan. So it may not hit your desk right away, but maybe a year later you can be presented with a nice bill saying, "Hey, you violated the non-solicit. I saw you close. There's recording, there's MERS, there's plenty of ways to check." So it's definitely a concern. And it's just something you sort of have to keep in the back of your mind whenever, number one, you're agreeing to these loan purchase agreements. And number two, when you're giving the guidance to the loan officer saying, listen, if you're going to be proactively soliciting, reach out to us to see if any of these investors do have any sort of language and what the time frame is on that language.
Yeah, agreed. To kind of go in the abstract on this one, I think again, the key for me is for lenders, broadly speaking, there's lots of different business strategies out there, right? To understand what kind of business model they are trying to operate. So to Ira's point, generally speaking, those non-solicit terms, there's a wide range of what that can be, but there's oftentimes exclusions for things like common business practices, basic borrower communication. They usually don't preclude loan officers, for example, from having broad-based marketing strategies like social media, broad email campaigns, and usually that it's okay if the borrower reaches out to the loan officer. So basically, to some extent, if the originating loan officer does a reasonable job of managing their CRM and keeping in touch with their previous book anyway, they have a reasonable opportunity to stay in front of the borrower for that potential refinance, kind of regardless. But I think it's really important to understand what kind of business model the lender's trying to employ. A lender, of course, that has a call center is going to feel very differently than a lender who is a traditional brick and mortar operation. Look at any industry survey that's been published recently. It goes without saying that profit margins are still pretty thin. In some cases, co-issue buyers and aggregators are incorporating something like a full servicing multiple into their value. And it's really hard to turn that down at some point, right? So on one hand, if the loan officer has a reasonable ability to stay in front of that borrower, then maybe it does make economic sense for a lender to pick up that extra income today and lower the odds of a refi in the future. But certainly on the flip side, if a lender has put a lot of time and effort into developing variant compensation structures and margin constructs and so on, and they really feel like they can compete for that next loan, then of course they'd have a different perspective. So for me, I think it's the thing I would emphasize is such a good timely topic. It's really understanding that lender's business model and their margin structure, and then having a good kind of internal conversation about where they want to be.
Mr. Chrisman, what have you been hearing from readers and your travels about this topic?
Well, it comes down to, in my opinion, once again, when you talk to originators or when you talk to CEOs, managers, and so forth, what are they doing to help their originators close loans or contact borrowers or keep in touch with borrowers? Because 2020, 2021, companies were adding servicing. 2022, 23, 24, into 25, companies were selling servicing. And the buyers of that servicing, they aren't buying servicing for their health. You know, they want those borrowers. So then the question is, the companies that are now I'm hearing starting to keep their servicing again, what are they doing to help their originators stay in touch, close loans, get in front of previous borrowers of loans where they sold the servicing? And you know, it may have been a year or two or three, and you know, the servicer obviously is throwing a statement at that borrower every month. You know, so they're in, you know, Chase or Mr. Cooper or whoever is in front of that borrower, but maybe that borrower remembers the time where they met the loan officer in a Starbucks, and the loan officer bought their kid a Danish at Starbucks, and that's in their head. And so it's up to the loan officer to keep that relationship, and use the tools that are offered by the lenders to say, okay, I've got this CRM, I've got this, you know, retention tool, or I've got this borrower mining tool. But what am I doing on a day in and day out basis to remind that borrower who I am and keep me relevant in their life? So,
It
my
would
two
seem
cents.
a little squishy, like from the possible liability point of view, that lenders maybe don't have a policy that is even investor specific, right? Like that, it seems there's some pretty clear stuff about, hey, what an LO can do to be in front of the borrower. But like maybe some LOs are pretty enterprising and they can put out, constant mailers with refinancings, and it would almost seem, and I'm not at a lender like you guys, Ira and James are, and Rob, all those you talk to. But it would seem that you kind of want to button that down a little bit and maybe just know what's going on and maybe put some parameters around that, just so there's not, it's kind of like a repurchase. You always live in terror that there's going to be a repurchase request, right? But, this is like another type of thing that I'm not sure we've been through enough cycles of with enough maturity to understand how the buyers are going to, come back on that or not. I don't know, maybe just, I know we just have a few minutes here. Any comments from anyone else on the squishy nature of that, or thoughts or best practices?
Yeah, I mean, I think to your point, it's we've never had a market quite like this. We've never had a situation where the entire industry effectively backed up the truck on servicing on one side, right? And then now we're on the other side, and we're going to see, presumably, hopefully, a downward trend in terms of rates. Um, the state of technology has changed a lot in the last couple of years, and we've seen some very large players be very public about their desire to do not just the next loan, but the next four in terms of the pricing that they're doing and so on. So, to your point, is there more of an aggressive stance by some of them? I guess we'll find out.
Anyone want to grab some last words before we close this one down? Guess not. Well, I guess that'll end today's, and I thank the sponsor again, Polly, for sponsoring us, and thank everyone for joining the call today.